We can say that the signals we hear from the talks are positive, but these signals can't silence the explosions of Russian shells.
We don't do any new business in Russia at all. All we're doing is winding down trades.
It's almost impossible to avoid a recession at that point.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Doubts in D.C. The U.S. expresses skepticism as Russia pledges to scale back military operations around Kyiv. Flashing recession, the 2-10 Treasury curve inverts briefly, reinforcing fears of a downturn. In Europe, Spanish inflation hits 9.8%. Plus, the great blockchain robbery. Hackers steal $600 million in one of the biggest crypto heists ever. Now, first, let's check on the markets because we have some great story, including that crypto heist. Our Eddie van der Walt will brief us fully on that. But if you look at the European stock 600, so we're seeing a bit of a reversal, maybe a bit of profit taking, maybe traders worried about the situation over in Ukraine with no immediate ceasefire agreed with Russia. It's very clear that the slide in long end yield, so the 2 to 10 year, this is what we're looking at, really briefly invert. Now, some saying this is the clearest sign of an impending recession. Others saying, look, because of the extra stimulus, the incredible stimulus that we've had over the last decade, it doesn't really tell us anything about the health of the economy. Certainly what does tell us the health of inflation is this natural gas futures gaining some 12.1%, and that's pushing up inflation figures. We heard Poland just a short while ago saying they will stop importing oil and gas from Russia this year. You can see the FTSE 100 pretty much unchanged. The DAX down 1.1%. Also similar losses for the FTSE MIB over in Italy, where they're 0.7% lower. Now, the U.S. says Kyiv remains under threat even after Russia has promised to scale back military operations. Now, a person close to the Kremlin told Bloomberg that de-escalation doesn't mean a ceasefire or complete withdrawal of troops, while the Ukrainian President Volodymyr Zielinski says there are some positive signals from the latest talks, though he also expressed some skepticism.
We can say that the signals we hear from the talks are positive, but these signals can't silence the explosions of Russian shells. Of course, we are seeing all of the risks. Of course, we are not seeing grounds to trust the words coming from representatives of the country that continues fighting to destroy us.
Well, joining us now is our Warsaw Bureau Chief, Piotr Skolimowski, and Bloomberg's senior reporter, Mark Champion. So thank you both for joining us. First of all, Piotr, what are some of the reactions to Russia's announcement of a pullback from around Kyiv?
So, indeed, I mean, the first reaction is obviously skepticism. We've heard from several officials. We've heard from President Biden, especially last night, where he said he really wouldn't read too much into what Russia announced. We also heard from John Kirby from Pentagon saying, well, actually, Kyiv is still at risk. Despite what Moscow claims is an attempt to de-escalate or pull back troops from around Kyiv. And the reports that we're getting today, this morning from Ukrainian side is that actually fighting continues. So around the outskirts of Kyiv, there's still there are skirmishes. So it seems like despite what we've heard from Kremlin, from negotiators yesterday, it's not really happening. In any case, what we've seen for weeks already is that obviously the invasion hasn't been making much of a progress towards Kyiv, and we've seen troops actually being sort of pulled back and sent rather east, where Russia seems to be focused right now.
And Mark, are there any signs that Russia's fundamental cutback in military activities in the north is working? And fundamentally, when Ukraine actually negotiates with Russia, can they trust them in terms of intention?
Well, as Piotr was saying, for what it's worth, overnight there was no sign of that. There was heavy shelling in all these different areas where the Russians said they would pull back. But more broadly, it's been a couple of weeks now where there's been consolidation by the Russians around Kyiv. they've also said that they want to switch their focus to the east. So when units move out up into Belarus again and regroup and replenish their forces and equipment, the question then is, where do they go? Do they go home, or do they go around to the other side of Ukraine and join the fight in the east? And in terms of what can be trusted, I mean, these kinds of peace talks are always incredibly difficult because the two sides have completely conflicting fundamental goals. One for the Ukrainians is to keep their territory and get the Russians to move out. And the Russians, for them, it is to achieve their goals and win. A leader like President Putin is very, very dangerous for him to admit a defeat, which, what Ukraine wants would be a defeat for Russia.
So, Piotr, what's the likelihood of President Putin and President Zielinski actually meeting?
Well, that's a good question, a million-dollar question, I guess. Well, at this point, obviously, that's what we've been writing about is essentially, obviously, it's good that there's some progress being made in talks, that at least they met in person. I mean, the negotiators. There is a basis for further talks, and maybe down the line there will be a meeting. But there's still so many hurdles to go through. There's no agreement on a ceasefire. There's no agreement on humanitarian corridors, really. Obviously, Ukraine is looking for certain security guarantees. It's not very clear on whether those guarantees will be assured. And what the Russian side has said is that only when we have something on paper, only then can both leaders meet, and that could be weeks, if not months from now.
Mark, I was going to ask you what Roman Abramovich, what you make of actually Roman Abramovich being at yesterday's talks. Is he really playing a mediating role?
Yes, he seems to have been playing a mediating role. He's been, shuttling back and forth between Kiev and Moscow. He's a reasonable person to do that. He still has good standing with the Kremlin. He's been outside of Russia long enough that he can be trusted to an extent by the Ukrainians, and they seem to. They asked the Americans not to sanction him so that he could play this role. I mean, it became public, so there was really no barrier to him joining the talks themselves, as he did in Istanbul. Whether he can pull anything off, it's quite interesting that the reported deal that he has been sort of trying to put together would require incredible climb downs from both sides. So it would be very difficult to achieve.
Wonderful. Thank you both for joining us with all of your great insight. The Warsaw Bureau Chief Piotr Skolimowski and Bloomberg Senior Reporter Mark Champion. Now, in the meantime, we also have Christine Lagarde, President of the ECB, speech in Cyprus, and that's generating headlines as we speak. She's talking, of course, about the war in Ukraine, saying, as expected, that it's posing significant risks to growth. Madame Lagarde also saying that cutting Russian energy creates costs during the transition. So for the moment, it's things that, of course, every economist would have thought about, but let's see whether, of course, it changes, and she gives us any more insight on what that means for ECB hikes. Now, we're joined now by Steen Jacobsen. He's Chief Investment Officer at Saxo Bank. Steen, as always, thank you for joining us. I have a million questions on inflation and whether the ECB is behind the curve and whether this is the right time to hike. Could they surprise? I mean, that inflation print from Spain, 9.8%, was stunning.
It's an absolute shocker, and I think the ECB finally is getting around to understanding what everybody else in the market understands, and that is that the PPI leads the PPI in the sense that it's broader and it is a more realistic. And as you know, Francine, we are running a 14% year-over-year inflation rate in Europe against the 5% benchmark. And now we see countries, open economies like Spain, getting to a level which is 10%, which is the midway between those 2 points. So in other words, the CPI is understating what's going on. And effectively also the market and the expectation on the ECB is so far behind, it's not visible what the target is in terms of where they get to. And I think it will be a dramatic change of policy that we are going to see during the year in the ECB. And then when they finally, as they always do, dramatically get to the conclusion that now they need to hike rates. But this and what happened in Spain today is very, very critical for that exact conversation.
So, Stine, first of all, does it make you want to change the way you're positioned in terms of your portfolio? And is there a risk that there's miscommunication from the ECB and so markets are taken by surprise?
No, not at all, because I think, Francine, we've had enough talks over the last 2 years. I've been on the structural inflation side. So this is more about getting a confirmation on the asset allocation that we've been running, which of course is exposure to the mining industry, to the logistic industry, to the cybersecurity industries and stuff that are, either independent or directly correlated to that inflation rate. But, to be honest, what I need to look at now is what comes next after everybody realized inflation is a real thing, because, 2 years ago, I was very, very alone in calling for inflation, and now it's a very crowded space. Fortunately for me, the majority, if not 80% of everybody I talk to, and I'm just back from London, they still think that the inflation is cyclical, not structural. So I think more surprises are coming, Francine, and more action is needed. And the central bank has never in monetary history been so far behind in terms of their action, because they gave up being pre-announcing policy to just like everybody else chasing the train down the platform.
I don't want to inflate your ego too much, Stine, but you were one of the only ones that called this right. So we'll see what happens the next 6 months and whether you call that right. Stine Jacobsen, Chief Investment Officer at Saxo Bank, stays with us. Coming up, cutting off Russian gas. Germany activates an emergency energy plan. We discuss the implications for investors and consumers. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. And we're also getting some breaking news out of Ben Broadbent from the Bank of England, saying that the Russian invasion is spurring inflation and weaker growth. Again, it's really mirroring what Christine Lagarde said, that Russian energy costs, of course, create extra costs during the transition. I mean, this is something, of course, that we know that economists don't, certainly markets have latched onto. We're back with Stine Jacobsen, Chief Investment Officer at Saxo Bank. Stine, when you look at the inverted yield curve, so half the people we speak to say this means impending recession, and the others saying, forget about it, it doesn't make sense because of the heavy stimulus that we had in the last 10 years. But if you couple the inverted yield curve with this higher inflation and lower growth, what does it tell you?
It tells me that most of the inversion is actually created by the inflation, which I think is missed by a lot of people. So if you took the real rates curves, they are still steepening. So in other words, all of the inversion that we've seen is actually the premium on inflation that sits on top of that. So to me, and someone who have used yield curve for many, many years, it's not a concern. And statistically, you're absolutely right. 50% of the time, the market actually goes into recession before it inverts, and 50% of the time, the yield curve calls it. So it's a 50-50. You could just as well toss a coin. And I think what is going on right now with the volatility, and that probably my biggest concern, the MOVE index, which of course is the bond volatility, is trading north of 100%, while the rest, especially the equity market, tends to see this as something that is passing by. And to me, there is more money, more sort of, let me call it as it is, intelligence on the yield curve in the US than there is in equity overall. So for me, this is just a sign that inflation is embedded. Market is struggling with sort of dictating what it means in terms of recession. But you're not going to get recession in the US this year. I mean, think about it. There are, 4 million jobs more than there are unemployed. They are the highest valuation that we have in the stock market. We have the net deposits in banks from consumers at the highest ever. Will there be some drawbacks on demand? Absolutely, but not to the extent that people see. And the same for Europe. I mean, we already, left, right, and center, during the political spectrum in Europe. Everybody's bailing out the consumer now on gas and down the line probably also on energy costs.
So, Steen, what does that mean for some of the currencies that you're watching? I know you're looking at yen crosses. I know you also, are putting a lot of emphasis or attention on what happens to sterling.
Yeah, no. So for us, I think Kuroda in Japan changed the whole dynamics of both the dollar and the trajectory of that through that policy statement that said, we are still in a place that we've been in the last 25 years doing absolutely nothing if we can get away with it. But let me point to the fact that the PPI in Japan is also running at 7 to 8%. So they will get inflation scares, and they are net port of energy. So for us, I think the dollar yen is about to peak. And I think the volatility that sits inside the fixed income market will spill into the foreign exchange market through that impact that basically the value of risk and the renormalization that needs to happen on the position needs to be away from what's been going on, which has been to, one-off, just basically buying the dollar yen in this respect. And in sterling also getting some relief, and it will be under pressure again as soon as the current account and the deficit plus the inflation becomes the equation by which the market sets the currency rate. So all of the currencies that are in play right now, except for the dollar, I don't see change. Sorry?
You're right. So you can't buy gold. You can't buy gold, given what we've seen. Or do you buy gold, or do you go into cryptocurrencies?
No, I buy gold, and I am long gold, simply for the fact that, as I said earlier in the last segment, that I think it's a structural inflationist thing. The market has to come to terms with the fact that, unlike what the central bank tell us about 2023, we're not going to get into the inflation rate down to 2.4%. It's not even a dream. It's a nightmare. If it happens, it means that the world has come to a standstill, and the world is not coming to a standstill. So for me, we are in a process in the next month or two where inflation expectations for next year will have to be repriced by central banks, and that impacts again the volatility in the fixed income market, but also, as you rightly say, in the foreign exchange market.
Steen, thank you so much. Steen Jacobsen, their Chief Investment Officer at Saxo Bank. Some great views, and I know we always get a lot of people also writing in, either agreeing or disagreeing with Steen. Now, coming up, crypto heist. Hackers have stolen $600 million from a blockchain connected to the Axie Infinity online game. All the details next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, hackers have stolen $600 million in one of the biggest crypto heists to date. Thieves attacked the Ronin network, a blockchain connected to the popular online game Axie Infinity. Now, Ronin says the breach took place on March 23rd, but it was only discovered yesterday. Now, for more, we're joined by Bloomberg's Eddie van der Veld. Eddie, I have 1,001 questions. So, first of all, why did it take 7 days for them to figure this out?
Yeah.
600 million.
Well, that's the unbelievable part of the story, right? These are big networks, but they are not that big that it will not make a dent in their wallets. So, whether they hadn't noticed or whether they just didn't announce, I think we will find out as the days go on. But I think the big story here is that the vulnerabilities in the crypto network has shifted, right? It used to be wallets, it used to be exchanges. Those used to be the big things that hackers used to target. Now they're targeting what is called the bridges, right? Which takes your cryptocurrency from, say, the Ethereum blockchain and transfers it, to another blockchain. And those are the networks that are they're not very transparent at the moment. People don't know who run them.
So does it, because it's then harder to trace, or because the actual connection is more vulnerable?
Yeah, I think the actual connections are more vulnerable. I think the network that does this is more vulnerable. So it's the way in which they store it and the way in which they transfer currencies from one network to another. Exchanges have learned their lesson. They will be very robust in how they treat these links between currencies. But when you're talking about a gaming platform, security is not the biggest concern for them traditionally.
So, Eddie, we don't know who's behind it, right?
We don't.
What else do we know? So do we know if it's traceable? Is it easier to trace, or because of where they hit, you actually don't know where it goes?
You often do know, so the people who specialize in the industry can often trace where the money has gone. In other words, to which digital wallet it has gone.
Yeah.
But in which jurisdiction the people are who executed the heist, that's a different story. And who owns the wallet, that's a different story. And whether they'll be able to claim it back. Because you see, this is the benefit of cryptocurrency. It's a lot like cash. Once it's in your wallet, and if your wallet is secure, it's very hard to pull it back. It's only when you introduce vulnerabilities into the system, like these bridges, that it becomes easier to hack and pull the money back. So it's a difficult one for lawmakers as well.
So is there do we need a regulatory body to make sure that if it's stolen, you get it back? I don't know how it works, or if the SEC or anyone else is looking at that kind of legislation.
Yeah, I think investors need to be a lot more savvy still at this stage. Sure, regulation, when there are any entities that trade in financial products, then regulation is needed, right? But these are not investment firms. So, asking them to adhere to know your client and all of those things, it seems ludicrous. They're a gaming company. So there will be regulation, but it's not going to be like we see in financial services, I don't think.
Eddie, thank you so much. As always, Bloomberg's Eddie van der Laat, our crypto king here in London. Coming up, M&A plans on ice after last year's boom. Many investors are putting deals on hold as the war in Ukraine unfolds. Well, we'll be joined by the chief executive of Raymond James, Paul Reilly, to discuss deals on the horizon. This is Bloomberg. Doubts in D.C. The U.S. expresses skepticism as Russia pledges to scale back military operations around Kyiv. Flashing recession, the 2-10 Treasury curve inverts, reinforcing fears of a downturn in Europe. Spanish inflation hits 9.8%. Plus, the great blockchain robbery. Hackers steal $600 million in one of the biggest crypto heists ever. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first thing is first, let's check the markets. The markets always give us a good indication, well, sometimes more days than others, about where they're looking at the fault lines. Now, stocks falling, oil rising. There's optimism about a de-escalation of the war. That was yesterday. Today, that optimism actually faded. We also had that slide in long-end yields, seeing the 2- and 10-year Treasury curve briefly inverting. Some say this is a definite sign of impending recession. Others saying, look, the accuracy is in doubt after years of heavy stimulus. And then we look at European natural gas gaining 13.7%. Now, the U.S. says Kyiv remains under threat even after Russia has promised to scale back military operations. A person close to the Kremlin told Bloomberg de-escalation does not mean a ceasefire or a complete withdrawal of troops. Well, the Ukrainian President Volodymyr Zielinski says there are some positive signals from the latest talks, though he also expressed some skepticism.
We can say that the signals we hear from the talks are positive, but these signals can't silence the explosions of Russian shells. Of course, we are seeing all of the risks. Of course, we are not seeing grounds to trust the words coming from representatives of the country that continues fighting to destroy us.
Now, the war is driving inflation ever higher, impacting global growth. The bond market has flashed a key recession signal. That 2- and 10-year yield curve briefly inverted for the first time since 2009. But it's not the only part of the Treasury curve to do so. The widely watched 5-year, 30-year gap also turned upside down this week, something that has not happened since 2006. Now, based in the U.S. with a large footprint in the U.K., Raymond James has $1.25 trillion in assets under management. Despite geopolitical tensions causing a decline in its investment bank revenues, the financial services group remains committed to M&A pipeline. Now, this week, Raymond James also announced it will buy the electronic bond trading firm SumRidge. Well, we're delighted to be joined by the chief executive who came all the way from the U.S., Paul Reilly. Paul, thank you so much, first of all, for coming here in the studio to have a good conversation about M&A and some of the pitfalls.
Well, it's great to be back live. It's good to be
I know,
here.
it's nice to be in person. Paul, give me a sense, first of all, of how you see this all playing out. There's higher inflation, could be higher interest rates. It could have a whole impact on advisories and investment firms.
Yeah. Well, the initial reaction was, although rates were rising, they were so low, people weren't too worried about it. Cost of capital was still low, low interest rates, still good financing, and a ton of cash. I mean, the system is flushed with cash. It's hard to put it places. So that was going to continue to drive M&A activity. Certainly the war and the uncertainty has kind of put a pause. So if you look at kind of globally, the M&A market's off 20%. The pipeline hasn't gone away, but people are being cautious. But in fact, in Europe here, we're on the same pace as we were last year. So
people are cautious because they worry about inflation. I mean, if we have even a 50 basis point hike from the Fed, it means, of course, that interest rates go up quite significantly. We haven't lived through this. Paul, there's a lot of people on trading floors that have never seen interest rates go up. So what does it mean for chief executives wanting an M&A deal?
Well, I think right now, if you believe rates are going up and capital's cheap, it's still relatively cheap to history. So it's a good time, right? You can still get low-cost financing, not as low cost as 6 months ago, but still cheap. And if you believe rates going up and inflation's going to increase the value of assets, you continue on. Now, I think the uncertainty in the economy with the Ukraine situation, with what the impact on oil prices, is it going to 200 or back to 80? I mean, those are the uncertainties that I think really cause people to pause in the short term.
How long are you expecting this uncertainty to stay with us? Will people at some point look through it?
I think they will if they think there's a satisfactory resolution of some kind in the Ukraine. I think that's the big driver. They're afraid that the spillover there can be so broad, both on oil and gas, economic, human tragedy, that's the uncertainty. I think if that goes away, the fundamentals are still okay, even with rising inflation, for investors to continue. But there's going to be an adjustment sometime. There's always a recession. It's been a while since we've had one. So.
Yeah, it has been a while. What kind of recession? Are you expecting a recession? And what kind of recession could we see? Is stagflation worse than a full-blown recession?
Maybe. There's always going to be a downturn, and my job is to always look at downturns. Upturns are always good, right? Yeah. You want to grow your business, but you have to be prepared in the downturn. So, but I don't see anything imminent. If you take the Ukraine situation away, and if oil prices stabilize, inflation's here, but rates are still cheap, and I think there's still plenty of room in the economy. At some point, people have to pay for all the COVID expenditures. Taxes are going to go up. When all that hits, and you're seeing proposals everywhere now, it's going to have an impact on the growth of the economy.
So when, again, in terms of timing, so when do you think that would be, and what does it mean for Raymond James in terms of acquisitions now?
Well, we're blessed. I mean, we get criticized by analysts for having too much capital, and in 2009 we made money in every quarter. So no, we keep it. So we're able to close on 3 significant, we think, important deals. One here with Charles Stanley, because we had the cash and capital. And so we less worry about that, but we are risk managers. We want to make sure if there's a downturn, we have plenty of capital. But we find the right opportunities. We're still in good positions to execute them.
What kind of opportunities would you look at? I know you recently bought, a online bond trading.
Yep.
Is it, these kind of like acquisitions in niche, or would you even go for something bigger?
Generally, we like to grow organically. That's been the secret of our long-term success. But where we find niche acquisitions that bring a special strategic advantage and fit our culture. So in Charles Stanley, we now have scale in the UK. We went from 150 advisors with 200 more, plus 175 on our platforms in 28 cities in the UK. So we finally have the scale that we think we can have the same growth and positions we've had in the U.S. and Canada, or three primary markets. In M&A, we continue to build out that franchise globally, especially focused here in Europe. And in other businesses, we look for those opportunities. The bond trading thing was a way of adding a product we didn't have in our very good bond fixed income trading, but most of their systems are all electronic. And we really believe it will catapult us if we can take those systems and use it in the rest of our business.
Paul, the UK, so you're doubling down on the UK. As you say, 150, you're adding 200. So you're confident that the UK as a financial service, I guess, is not going to go away because of Brexit?
No, I think it will continue. We've been working on this deal. My first meeting with Sir David Howard was 7 years ago. And I told him we were patient. We viewed it would be a great fit, but when were they ready? And they were ready this year. So over all the years, this wasn't a whim. It was a long-term strategic decision. So, we're comfortable in this market. We've targeted really North America and the UK as our wealth businesses only. And then with M&A, it's more of a global business. Yeah.
I mean, we had a lot of Russians here. Some are sanctioned, some are not. Does that change the landscape for wealth management in the UK?
Not really, because it really didn't impact us. I mean, it impacts us as it impacts the world, but in terms of we really didn't have a business with the Russia or the Ukraine. So from a direct business or indirect, there's really been no impact to us outside of the economic impacts of this whole situation. Yeah.
Do you have, as a wealth manager, actually need to take a constructive view on crypto? I don't know how many people ask you about it, or whether it's something that for the moment you just don't want to get into.
Well, there's a couple of questions. We believe, certainly a lot of people talk about blockchain. It's a great technology, but that's separate from crypto. Crypto uses blockchain. We still have concerns with the underlying valuation, the speculation, and frankly, in most markets, the regulation has basically said, we want you to stay out of this until we approve them, their securities. Well, we can't sell them, we can't sell them. But we're still concerned on the valuation. We like when clients get statements, we can tell them what the value is. And in crypto, I think we're having a harder time saying what that real economic value is. Yeah.
So do you see more opportunities in the UK? I know we were talking about, possible M&A, the fact that you have cash.
Yep.
Would it be in the UK, or would it be to go after another market regionally, geographically?
Yeah, our 3 geographic markets are still US, Canada, and the UK. And with Charles Stanley, our first job is to make sure that that combination, as our family's expanded here, is done well. So we're going to spend the first year mapping out the systems, second year integrating them, making sure that we get the best of both, because we learn from each other when we do this. And that's job one. We don't want to do another acquisition on top of it when we don't have the platform integrated. And M&A, we're constantly looking for people and boutiques that would fit here in Europe and in London in particular.
All right, Paul, thank you so much. Paul Reilly there. So good to speak to you here on TV, the Chief Executive of Raymond James. Now, I was a little bit distracted just because we have some breaking news from the ECB. There's a number of central banks now that are coming out trying to gauge what kind of inflation they'll have to deal with. We also have just had an update from the UN Refugee Agency saying over 4 million refugees have now fled Ukraine. Now, let's get straight to the Bloomberg. First word news, here's Laura Wright. Hi, Laura.
Hi, Francine. The U.S. says Ukraine's capital, Kyiv, remains under threat, even after Russia promised to scale back military operations there. President Biden said he'll wait and see whether Russia delivers on its pledge made after peace talks in Istanbul. The negotiations did not result in a ceasefire agreement, though Kyiv said it's willing to discuss the status of occupied Crimea, while Russia indicated a meeting was possible between the two countries' presidents. Russia's Foreign Minister Sergei Lavrov has arrived in China for talks on Afghanistan in his first visit to the world's second largest economy since the war in Ukraine started. It's the first opportunity for high-level, in-person discussions between the diplomatic allies since Vladimir Putin's invasion of Ukraine. Staff at Citigroup and HSBC in London faced disruption yesterday as a major power failure across the east of the British capital knocked out computer networks and led to the activation of emergency electricity supplies. A Citigroup memo suggested disruption could extend into today. Hackers have stolen about $600 million from a blockchain system connected to the popular Axie Infinity online game. Ronin Network says thieves took Ether and USDC tokens a week ago, though the breach was only discovered yesterday. The stolen funds reportedly went to 2 cryptocurrency exchanges in what is one of the biggest ever crypto heists. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thanks so much. Coming up, sanctions against Russian billionaires are meant to cripple the country's ability to wage war. Not all of Russia's richest are being hit. So more on the Big Take next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, half of Russia's 20 richest people have been sanctioned over the Ukrainian war. Now, 4 of the 5 top billionaires remain free to operate without legal sanctions or restrictions. A Bloomberg analysis shows that they are among a group of powerful Russian tycoons who've so far escaped penalties. And that's the subject of today's Big Take. Now, for more, we're joined by Bloomberg senior writer for investigations, Stephanie Baker. Stephanie, this is a brilliant piece of research. You went through data. So first of all, why did you and your colleagues, such as Marian Halftermeyer, Alex McIntyre, decide to pursue this investigation?
Right. So besides weapon supplies to Ukraine, sanctions have been the central tool to counter Russia's invasion of Ukraine. And it's just been a dizzying stream of Russians who've been sanctioned, yachts and mansions seized. So we tried to go through the list of the wealthiest Russians to make sense of who's blocked, who's not. And in the end, it looked like a head-scratching list, a patchwork of penalties that sometimes makes sense and other times really doesn't. It was hard to track who's sanctioned where. Some people are sanctioned in the EU and the UK, but not in the US. Likewise, some are sanctioned in the US and not the UK, which really reveals that Western allies, while coordinating, are not exactly on the same page.
So what exactly, can you tell us about what you found out? Sometimes it seems a little bit haphazard who was sanctioned and not.
Right. So what we could discern, if there is a pattern to pull out from this, is that there seems to be a reluctance to sanction billionaires who play an outsized role in certain key markets like metals, energy, steel, fertilizers. Those are markets where Russian supplies are really key to global markets. And sanctioning any of these billionaires who either own a significant stake or in many cases a controlling stake could then trigger sanctions on their companies. And I think there's a real worry that with sanctions, I think Western policymakers want to make sure that the sanctions are hurting Russia more than they are hurting the West. And I think in some cases, they are perhaps looking at trying to come up with a plan for how to sanction certain individuals without causing market spillover. And that has been the overarching aim, to cause maximum pain to Putin while minimizing the spillover to the global economy.
I mean, the million-dollar question is, of course, whether these sanctions work. And also, how do you explain, for example, Stephanie, Roman Abramovich, who's sanctioned here in the UK, but not by the US?
Right. And our colleagues in the U.S. have confirmed that, indeed, President Volodymyr Zielinski had asked the U.S. to refrain from sanctioning him because of the role he was playing in the peace process. Now, he's a prime example of one of the Russian billionaires who say, well, he's not close to the Kremlin. He has no influence over the Kremlin, but clearly if he's involved in the peace process in this way, he must have some sway. So I think that is the real disconnect there. How it's hard to measure distance from the Kremlin and connections to the Kremlin. In some cases, it's easier to make those ties. In other cases, it's not.
Thank you so much. Bloomberg senior writer for investigations, Stephanie Baker, with a great story. We'll push it out on social media, and then you can also read more on our Big Take stories at NI Big Take. Go on the terminal or on Bloomberg.com. Now let's get straight to your Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Uber is taking its ambitions in delivery beyond food and into retail. In an exclusive interview, the CEO, Dara Khosrowshahi, compared Uber's offerings to Canadian e-commerce company Shopify, which helps merchants set up and operate their digital storefronts. He says the delivery business could eventually grow to be bigger than rides.
I think that Amazon is an incredible company, and no one is ever going to replace Amazon. But we can essentially use our technology, local logistics capabilities to power the local merchant or restaurant to deliver anything within an hour, which we think is a delightful experience.
Micron Technology is giving an upbeat forecast for the current quarter. The largest US maker of memory chips expects sales for the third quarter to come in at around $8.7 billion, above the average estimate of $8.2 billion. Data center sales grew more than 60% in the latest quarter, with revenue from automakers setting a record. That's the Bloomberg Business Flash. Francine.
Laura, thanks so much. Coming up, recession risk. We discuss whether the brief 2-year, 10-year yield curve inversion is a reliable warning signal of an impending downturn. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the bond market has flashed a key recession signal as 2-year, 10-year yield curve briefly inverted for the first time since 2019. Last time I misspoke, but this has definitely happened in 2019. It's not the only part of the Treasury curve to do so. The widely watched 30-year gap also turned upside down this week, something that has not happened since 2006. Now, it comes as a pressure on central banks to hike rates mounts as inflation runs super hot. Now, for more, we're joined by our MLive editor, Ven Ram. Ven, you're an expert in this. I know we talked yesterday about whether we should panic or stay cool about some of these inversions. But first of all, given what happened yesterday, how many more of these brief inversions are you expecting, and how difficult are they to predict?
Well, I don't think we are going to expect a recession just because of the two-stance inversion, Francine. There are two ways, basically, we could get a curve inversion. One is by front-end rates surging, and the other is by long-end yields sliding. You typically get a recession when the long end rallies, i.e. the long end of the curve pulls down. However, what we have seen in the past 2 quarters is that the front end yields have been surging. So this is not a sign of a recession. In fact, ahead of a recession, the front end would rally, if anything, and not sell off like we have seen. So this is a different inversion than the one that we saw in 2019.
But do you worry about, and this is your piece today, which is brilliant, do you worry about this being a self-fulfilling prophecy, a little bit like inflation expectations? And I think Governor Kuroda was the last one to make that link.
Thank you. I do think that this is going to have an effect in so much as it alters the behavior of companies in hiring, the behavior of traders who start thinking, oh, maybe is there going to be a recession, and start second-guessing themselves. To that extent, it's going to have an adverse feedback loop. And yes, it's going to affect the economy. And therefore, I do think that a slowdown is coming, probably next year. But I don't think this is going to be a recession like we are fearing.
Yeah. So what does this mean, Ven, for central banks?
For the Fed, I don't think this is going to stop them. This is something they already saw coming. Powell has already acknowledged in previous meetings that this is one of the indicators that they are watching, but I don't think they're going to lose sleep about the inversion for the reasons that we just discussed. For them at the moment, the biggest problem on the horizon is inflation, and they're way behind the curve compared to where inflation is and where they need inflation to be. That means that they are going to go all guns blazing out on against inflation. And that's what is going to happen. The Fed is going to keep raising rates this year. I don't think they're going to slow down. We are going to get 6 more increases by the end of the year. And that's what is going to happen. Next year, we may see a slower economy.
Ven, thank you so much, as always, for your analysis, our MLive editor. Now, Bloomberg Surveillance Early Edition continues in the next hour. Anna Edwards, Kailey Leinz, and Lisa Abramovitz. This is what the markets are telling us. So stocks falling, energy prices rising, optimism about a de-escalation of the war in Ukraine seems to have faded. Maybe there's also a little bit of profit taking. We saw the slide in yields, the 210 Treasury curve briefly inverting as we were speaking about it with Ven. Is this accurate like it used to be in the past because of years of heavy stimulus? So is it really a signal of impending recession? I know the next hour we'll also discuss this. This is Bloomberg.
I think that the pressure is going to remain on Putin as long as Putin's still in power.
It's in the long-term interest to make sure that Russia somehow, by itself, transitions to a more democratic equilibrium.
Russia is too weak to win, but at the same time, they are too strong to lose.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, March 30th. Our top stories today. There's plenty of skepticism about that Russian pledge to pull back troops from Kyiv. A person close to the Kremlin says de-escalation does not mean a ceasefire or a complete withdrawal. The bond market flashes a brief recession signal. The U.S. two-year yield briefly exceeds the 10-year for the first time since 2019 and is one of the biggest crypto heists ever. Hackers steal about $600 million from a blockchain network connected to a popular online game. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Kailey Leinz is with me in New York. Lisa Abramowitz is also with me in New York today. Matt Miller is off today. And Kailey, it was really fascinating to watch European equity markets and global equity markets through the European session yesterday into the US, into Asia, really bouncing on hopes, expectations that perhaps we will see some de-escalation in the war. But those hopes quickly fading as we move into, well, through another European day.
Yeah, but as you allude to, Anna, they were not yet faded in Asia, where we did see a positive session for equities overnight. The MSCI Asia Pacific Index was higher by about 0.8% or so. One of the outperformers within that was China. The CSI 300 up nearly 3 percentage points. Part of that was due to strength in property stocks in particular. But the real story out of Asia I want to focus on is the Bank of Japan, taking more unprecedented measures to interfere in the bond market, keep yields in, now buying out in duration, the longest end of the curve. And you saw that reflected in the 30-year yield, which came in around 6 basis points overnight to just about 1%. The Japanese yen, meanwhile, of course, broke through 125 earlier this week, but strengthening down back to that 120, 168 level or so. Kuroda speaking overnight, really trying to separate out what they're doing on the bond front from the weakness of the Japanese yen. Now, as for the picture for U.S. assets, as you allude to, Anna, we are seeing sentiment rolling over after the gains of yesterday. Right now, S&P 500 futures are off by about 0.3% or so. The 10-year yield relatively unchanged. We're sitting right around 238. But of course, it was really all about the curve yesterday. That brief inversion between 2s and 10s. It is now steepening back out. We're about 6 basis points separated between short end and longer end yields at the moment. We're seeing a rebound as well for crude as the market continues to digest the exact prospects of the potential peace deal between Russia and Ukraine. How much progress really was made in those talks in Turkey yesterday? WTI is up about 2.7%. We're trading right around $107 a barrel, and a little bit of weakness for Bitcoin today, Anna, trading right around that $47,000 level.
Yeah, absolutely. Kailey, here in Europe, equity investors are still trying to digest exactly what hopes for de-escalation really mean, really amount to, and what the proof on the ground really looks like. We'll get more details on that. But for the moment, we see stocks are weaker, considerably so in the German market and in the French market. Energy stocks helping the London market maintain a little bit more solidity, actually fairly flat here on the London market. Let me show you what else is going on here in Europe, in the European trading space, and in particular, a focus on what's going on in bond markets. So we had inflation numbers out from Spain and various parts of Europe already today. We get German inflation data coming through a little bit later on. And with that in mind, we are keenly focused on what is happening on the short end of the German curve. And in fact, this positive number, it is only just positive, isn't it? But it is positive, and that is the first time we've seen a positive reading on the 2-year since 2014. And so that is certainly something that the markets are focused on. The inflation dynamic then very much at the heart of things today here in Europe. And this is another example of that. This is the European gas benchmark, up by just shy of 14%. The Germans coming through in the shape of the economy minister with part one of a 3-step plan to try and ensure energy security as we get towards the winter or into the winter, as they are acutely aware, of course, in Germany of what kind of response they might see from Russia if they refuse to pay in rubles for some of the energy products. So we continue to focus there. Renault is down by 4.7%. The market's increasingly focused on what's going on with businesses that are exposed to Russia, and Avtovaz is a part of the Russian empire, of the Renault empire, and that as a result of that, we are seeing a big focus on that asset and what they can do with that. Can they offload it to a local owner? That is the focus. I had UBS in there as well. They're doing a share buyback. Quick focus on the Russian stocks. Russian stocks up by 2.7%. The Russian ruble actually managing to get back to levels we haven't seen since before the invasion. So a lot to talk about when it comes to the geopolitics and the war ongoing in Ukraine, Kailey.
Yeah, and of course, we will continue to monitor any and all headlines that cross on the geopolitical front today. But there is also a lot else ahead, including more Fed speak. We'll hear from Cleveland Fed President Esler George and Richmond Fed President Thomas Barkin. Barkin will be joining Bloomberg TV for an exclusive interview at 10:30 a.m. New York time. Then we'll get some U.S. economic data, including ADP employment and personal consumption, and PCE, which of course is the Fed's preferred inflation gauge. And finally, UK Prime Minister Boris Johnson will be facing questions before a parliamentary committee. He will likely be grilled on Partygate and the UK's response to the war in Ukraine, Lisa.
Meanwhile, I will say skepticism is really what is ruling the day. It's what's going on when we look at Russia's pledge to scale back military operations around Kyiv. NATO allies are evaluating whether the pullback marks a turning point in the conflict or simply a tactical shift. Emily Wilkins, Bloomberg government reporter, joins us now for more. Emily, what's been the takeaway from the meeting that President Biden had yesterday with a number of his peers over in Europe?
Well, the mood in Washington, and certainly the mood after this call, was very much wait and see. Wait and see what a de-escalation looks like to Russia. No one's expecting a ceasefire. No one's expecting a withdrawal. But they are expecting to see less attacks on the capital city, although experts warn that that could mean that Russia is just going to be concentrating its forces in the eastern Donbas region. At this point, it does seem like the Biden administration is anticipating that this war could go on for much longer. We've got reports now that the Biden administration is actually looking to provide another $500 million to Ukraine. That would be for humanitarian as well as military aid. And lawmakers are also getting briefed on this conflict today. So Washington is not winding down its focus at all on this region.
And obviously not winding down on the sanctions front either, Emily. In fact, pledging to make them even tighter. Has the U.S. given any indication of what the response would be should a de-escalation actually materialize, if it would mean the unwinding of any of these measures that have been taken in retaliation for Putin's action here?
Well, certainly when you come to wider discussions, I mean, there is a question of when sanctions should be lifted, if sanctions should be lifted. I think for a lot of lawmakers, a lot of officials here in Washington, there's a giant breach of trust in what Russia did and in what Putin did. And I don't think anyone's expecting there to be some sort of agreement and all the sanctions to be lifted. I think there's still a lot of concern about the nature of the relationship. And even if you heard from the Pentagon yesterday, spokesman John Kirby had very strong rhetoric, even stronger than the president, saying that we shouldn't be fooling ourselves with the idea that Russia is going to be withdrawing from Ukraine at this point. He suggested that it was a repositioning, not a withdrawal, and that there was no indication that there was any sort of major change onto Russia's stance on Kiev.
Right, so that's the Pentagon line, and worth saying that attacks have still been reported overnight in the Kiev region, so we have that to go on. Emily, thank you very much. Emily Wilkins of the Bloomberg government team joining us there from Washington. Now, the U.S. two-year yield briefly exceeded the 10-year yesterday for the first time since 2019. This reinforced the view that that Fed rate increases may cause a recession, but Erin Brown, a fund manager at PIMCO, says those concerns may be premature.
There's reasons to believe that this time around, yield curve inversion may not be as good of an indicator as it has been in the past, particularly given the enormous amount of quantitative easing undertaken by global central banks.
Let's get more with Bloomberg's Danny Berger. So it was quick. If you blinked, you maybe missed it, and some of it reversed then pretty quickly. Where does this leave us, this very brief inversion of the 2s10s?
Well, and it certainly has fueled this debate, however brief it might be, as to whether this means a recession is coming or not. Of course, the long-running joke is that the yield curve has predicted 7 out of the past 5 recessions. But I want to linger there on that argument coming from PIMCO, because it's a similar one that Mike Schumacher over at Wells Fargo made in a paper yesterday as as well. And the whole idea here is that the Fed's intervention in the bond market has removed the mojo, if you will, of the yield curve and its predictive power. He wrote that bond buying has dramatically lowered long-term yields, making yield curves unduly flat. This shift has weakened the link between Treasury curve shape and growth, so the long end is naturally suppressed. Of course, not everyone buys this argument, and as the chaser to the shot, I give you Jeff Gundlach's tweet, who essentially says, right on cue, it doesn't matter, this time white papers are coming out. Don't believe them.
I will say, Danny, that's what a lot of people are saying. It's this push-pull between, is this time different? Is this time different when it comes to the Bank of Japan? Because what we saw overnight is them accelerating their bond purchases. At this point, what's left of the market in Japan?
It's so true. Liquidity is so thin. I mean, this is a market where essentially the BOJ is the only one involved in it. And it is different, Lisa, because these were already unprecedented moves. A 3-day operation to defend their upper bound of 25 basis points on the 10-year yield. And then they go and they surprise markets again today, buying even more and on the long end as well. So that means long end comes in about 6 basis points. And we're also seeing a 10-year yield that's at 22 basis points. So at least for now, Kailey, it has been successful in defending this upper bound, but there's this lingering question of how much further, how much more power does this yield curve control have in Japan?
And what does it mean for the Japanese yen? Thank you so much to Bloomberg's Danny Berger. Meanwhile, in the cryptocurrency universe, hackers have stolen $600 million in one of the biggest crypto heists to date. They attacked the Ronin network, a blockchain connected to the popular online game Axie Infinity. Ronin says the breach took place on March 23rd, but it was only discovered yesterday. For more, we're joined by Bloomberg's Eddie van der Walt. So, Eddie, what exactly happened here? Talk us through what did and why it took so long to notice.
Yeah, it's a really interesting story here because it's really moved the narrative on for, what a hack in the crypto space looks like. A few years back, we were talking about hacks of exchanges. Then we were talking about hacks of wallets. Now, what they're targeting is bridges. These bridges take cryptocurrency from one blockchain network and then take them to another utility-based network. So, for instance, from the Ethereum network to this Ronin network. And those are, so the security of these are not as robust, perhaps, as they are at some of the crypto exchanges. And I think that's what we're seeing here. We're seeing a real evolution in how hacks are taking place.
Okay, this evolution in how the hacks take place then, Eddie, no doubt has the attention of regulators. Does this tell us anything about how far we've come in turning crypto into a sort of fully grown-up asset class?
I think it does tell us that crypto is starting to grow up, right? I think because hackers are having to now target more niche areas of the network. So I think it shows that the other parts of the network is becoming more robust. They can't target the exchanges. The exchanges have now, fully moved into this world where they know they're dealing with people's money. I think when you're targeting gaming networks, when you're targeting private company end users, as it were, of the cryptocurrencies, it shows that the network is more robust. But it does show that there is still vulnerabilities. And yes, I think the regulators will take a look at them.
All right, Bloomberg's Eddie van der Walt, thank you so much for joining us. Now let's get back to the equity markets and take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with Micron, a big outperformer in early hours after reporting results yesterday. A really rosy revenue forecast, topping street expectations, showing really strong demand still for its data center chips. That stock is up about 4% in early hours. Plunging to the downside, though, is Chewy. Of course, this is the online pet store. It missed expectations when it comes to revenue guidance, expecting slower growth as that pandemic-era puppy boom ends. I guess everyone already got their pandemic puppy. I include myself in that, Anna. That stock is down about 14% before the bell. And finally, just a quick check on Apple, because this stock is coming off an 11-day winning streak, its longest since 2003. And it does look like that may snap today. Right now, Apple is down about 0.6% or so in pre-market trading, Anna.
Kailey, thank you. Now, coming up on this program, high inflation continues to add pressure on markets. We will speak with the Bank of Ireland's head of inflation trading, Semin Power, and navigating sanctions, how one fintech company is helping banks and businesses get Russian clients off their books, identify who is sanctioned exactly and what to do about that. Plus, we'll stick with that sanction theme. Sanctions against Russian billionaires are meant to cripple the country's ability to wage war, but not all of Russia's richest are being hit by the sanctions environment, and it is patched flashy from one geography to another. More on that big take story ahead. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, alongside Lisa Abramowitz and Kailey Leinz in New York. Matt Miller is off today. There was a lot of attention, of course, on the short ends of the US curve yesterday, and it was all about twos, tens, and that very brief inversion. Today here in Europe, though, there's a lot of focus on the short end of curves, and in particular the German curve. Let us go to Francine Lacqua of the Bloomberg Markets, Bloomberg Markets editor, who's with me on set here in London to discuss. And you can see that stunning rise in the German two-year on the far side of this chart. And if this closes in positive territory, then, Christine, this will be the first time since 2014 inflation expectations here in Europe really on the rise.
Absolutely, Anna. And we're seeing that getting borne out in pricing for the ECB as well. Just this morning, we saw traders moving forward their expectations for when the ECB will end its negative rate era and head to zero. They're not expecting that to happen in October versus December previously. So you can really see traders inching closer and closer to really pricing in that regime shift, if you will, for the ECB. And that's definitely getting borne out, particularly by the German two-year yield. It's the last stalwart of its kind in terms of negative yields. And the fact that we're seeing this now, this historic moment, possibly really marking that milestone for Europe.
Christine, there was an interesting moment yesterday, a sigh of relief in markets when the prospects of peace talks seemed to be much more real than they have in the past. And then people started to worry, does this mean faster than expected rate hikes, not only by the Federal Reserve, but also by the ECB? What's the general feeling among analysts you've spoken to on this?
Yeah, Lisa, I think it's a very good point that, you know, it was a question a little bit of how the potential de-escalation in Ukraine would impact the broader markets environment. I think the conclusion is that in some ways, what we saw in Ukraine and the risk aversion that followed was potentially a mere break in the process of normalization globally. And now that we're potentially seeing this de-escalation, we could see, again, a faster pace of tightening. But, you know, even before we saw the situation in Ukraine really deteriorate in terms of what's going on in the ground, there was already a lot of inflationary pressures that would justify big rate hikes from central banks this year. And I think that's coming back to the table now.
Well, Christine, what else we saw yesterday was a very brief, but it did happen, inversion of the 2s-10s yield curve. A, does it matter? And B, does it matter as much as other curves that we know the Federal Reserve is looking at?
Well, Kailey, Jay Powell himself, of course, said that it's not really the 2s-10s that he's looking at in particular. It's the shorter end of the yield curve. And so I think, you know, this lively debate over yield curves is always going to be there because there's always going to be the camp that thinks it really is a very reliable recession indicator. And then others, like PIMCO, for instance, saying that, no, it really has lost its predictive power. I think to anyone who kind of is looking at this, it would be one key question to ask is how much faith do you have in bond markets' ability to predict the economic trends, the state of markets 12 months out? And that really would be a good guide as to how much credence we assign to yield curves, various parts of the yield curves, and how much predictive power they have at this stage.
Christine, thanks very much. Bloomberg's Francine Lacqua. And for more market analysis, check out the Markets Live blog. MLIV Go, that's the function to use on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Lisa Abramowitz in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. A team of U.S. investigators is headed to China to help determine what caused that China Eastern Airlines Boeing 737 to crash. The group includes experts from Boeing, the FAA, and the National Transportation Safety Board. The jet plunged from its cruising altitude of 29,000 feet. The House committee investigating the insurrection at the Capitol last year has questions about former President Trump's calls that day. They've uncovered a 7-hour gap in the president's phone logs. The gap covers a period when lawmakers were trying to get him to quell the mob. Hedge funds that accepted Roman Abramovich's billions now have no way out. He's been sanctioned by the U.S. and EU as part of the penalties against billionaires believed to be close to Vladimir Putin. Now those firms that took his money are stuck. They can't get rid of the tainted funds, but they can't immediately collect fees on it either. And Uber wants to out Amazon. Dara Khosrowshahi, the company's CEO, tells Bloomberg that it's taking its ambitions in delivery beyond food and into retail.
I think that Amazon is an incredible company and no one is ever going to replace Amazon. But we can essentially use our technology, local logistics capabilities to power the local merchant or restaurant to deliver anything within an hour, which we think is a delightful experience.
Khosrowshahi says Uber's delivery business could eventually grow to be bigger than rides. And Anna, to me, that really highlights the contrast between Uber and its competitors like Lyft that are really just strictly focused on ride hailing, that don't have that other component that can potentially provide more insulation and growth opportunity.
Yeah, absolutely. How much is it a sort of strict one product business model, and how much does it move into other areas? Trying to out Amazon sounds like a tough ask, but you know, maybe if anyone can do it, maybe Uber can. Getting anything delivered within 1 hour, I do wonder what the green impact of all of that is. Yeah. But you know, maybe that's a story for another day. When we come back, we'll talk inflation. Semin Power, Bank of Ireland head of inflation trading, joins us. We've had inflation data out of parts of Europe that has once again, no surprise, beaten estimates. What's going on? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Russia's offer to cut back military operations in northern Ukraine has sparked optimism, but there's strong reason for caution. Russian commanders had already said they plan to reconcentrate their forces in eastern Ukraine. The bond market flashed a recession signal. The U.S. two-year yield briefly exceeded the 10-year for the first time since 2019. That reinforced the view that the Federal Reserve rate increases could throw the economy into reverse. And it's one of the biggest cryptocurrency attacks ever. Hackers stole about $600 million from a blockchain network connected to the popular Axie Infinity online game. They targeted what is known as the Ronin Bridge and drained Ether and USDC tokens in 2 transactions. I'm Anna Edwards in London, alongside Lisa Abramowitz and Kailey Leinz in New York. Matt Miller is off today, and in Matt Miller's absence, Lisa, it is very nice to have you here with us at this early New York hour on the program. What has caught your eye as we head towards the start of U.S. trade?
What it is the sense of show me what is going on. Don't necessarily take Russia's word for it. And that, frankly, is what you're seeing in markets right now. You're seeing S&P futures retracing some of the gains from yesterday, down about 0.3%. And you're seeing the 10-year yield kind of in the stasis place as people try to figure out where we are, although inching a little bit higher over the past couple of minutes to 2.4%. Crude rebounding also as people assess the likelihood not only of some sort of real ceasefire, but also of the lifting of sanctions. Does not look likely anytime soon. And the dollar weakening for a second straight day. To me, I find this really interesting, Kailey, because what it signals to me is that the dollar as the haven trade no longer works as people assess the inflationary inputs and what the central banking response might be.
Well, then what is the haven trade, given what we've seen in the Japanese yen? I guess that really is the ultimate question. Now, I want to take a look at some individual stocks moving in early hours here in the U.S. because there are a number that are worthy of note, including Micron, which reported earnings after the bell yesterday. Really strong forecast driven by demand for its data center chips. That stock is up about 4.3%. You also have WeWork higher by 3%. Its CEO is now also its chairman, plus a SoftBank director is joining its board. To the downside, though, Chewy, weak revenue forecast, expecting slower growth in that pet space as the pandemic era boom fades for that company. It's down about 14% in early hours. And finally, also lower for the first day, potentially, after 11 days of gains, the longest winning streak since 2003. Apple looks set to snap that streak today. It's lower by about 0.6% before the bell, Anna.
Kailey, let's think about where we are on the European session then. 2.5 hours into our European trading day, and European equity markets do seem to be consumed by those concerns that maybe we need to see demonstrated pullback by Russia before we really believe it's happening on the ground in Ukraine. And so we take some money off the table for European risk assets. The stock 600 down by 0.6%. And some of those equities that are exposed to Russia, exposed to Ukraine, are the ones that are being sold off once again here. This is a big focus. We talked about this with our colleague Christina Aquino earlier on today. This in positive territory. The 2-year German yield up in positive territory for the first time since 2014 if it closes above that level. Renault in focus, the car maker down by 3.8%. They have a big stake in a Russian automaker, the maker of Lada vehicles, AvtoVAZ. They told us a while back they were getting out of that country, but now they've got to work out how exactly they do that. Will they transfer that asset to a local investment business? That seems to be the talk of Renault this morning. And UBS, that stock down by 0.5%, despite the fact they came forward with a buyback this morning. Kailey?
All right, Anna, well, we have to talk more about inflation in Europe. Consumer prices in Spain surging to nearly 10%, the fastest inflation rate in almost 4 decades. Germany will release inflation data later on today, following by France and Italy tomorrow. Then Euro area data as a whole will come out on Friday. Well, all of that, too, top expectations. Joining us now is Semin Power, head of inflation trading at the Bank of Ireland. Semin, how much longer can inflation stay this elevated in Europe, and have we seen the peak yet?
No, not really. First of all, hi, good morning. Thanks for having me. Actually, ourselves, together with the markets, revised higher our inflation projections. So for this week, we believe about 7% print around 7.2 is likely. Versus 5.8 last month. And also on the core print, we are expecting to see actually core inflation move above 3%. So obviously, Ukraine-Russia conflict is adding additional pressure. But even before the conflict, the energy market was super tight. Market was looking for Brent oil to trade about $100 per barrel on the back of higher travel demand. Post-pandemic. Now with Ukraine-Russia conflict, market forecasts have even increased further, and we are discussing $150 per barrel for Brent for the second quarter. And again, looking at today's data and looking at the last print, it's not just higher energy and high agricultural commodity prices, but looking at the CPI basket across items, we are seeing broad-based upside price pressures, and also we are seeing services prices pick up significantly. So now inflation market is expecting about 7% for throughout the year, basically, until very late Q4. And even then, we don't expect headline inflation to fall below 6%. And again, with the risk of the headlines this morning, Russia pushing for payments in ruble, which opens the risk of renegotiation of long-term energy contracts. Again, the risk is on the upside.
Okay, so risk to the upside. So inflation angst stays with us, regardless of what happens on the ground in Ukraine, Semin? Is that the way you see it?
Yeah, I mean, obviously, with Ukraine now, we are in a multipolar world of US and its allies versus China and Russia. So the deglobalization trend is turbocharged, and the reshoring of production lines will continue. The transition into renewables has accelerated. But as I said, even if the Ukraine-Russia ceasefire turns out to be more permanent, we still believe the energy market will remain very tight as demand is still picking up, and we are not actually expecting to see a big revision lower.
Okay, and we've talked a bit about your inflation expectations, and I know that that maybe you've had some success in accurately predicting some regions of the world and their inflation. But as a body, as a whole, economists seem to have struggled to keep up with the rate of inflation that we're seeing in all kinds of different geographies here, Semin. What is the big explainer of that, do you think? Is it that economists have been underestimating how much consumers were prepared to put those savings to work in consuming higher priced items, or what's been unforeseen by economists, do you think?
I guess people are still looking at the dynamics in the last session and the financial crisis, and how we were for a long time in a low growth, low inflation environment. And maybe the projections for inflation volatility were lower as well. And this time, obviously, the first game changer was that the fiscal space is used much more actively. So there was no austerity measures. If anything, we had very expansionary fiscal policy measures. And again, I think we are seeing a big shift also on labor claiming back its share. And actually, even going forward now, for example, ECB have communicated that they were looking for about 3% wage pressures in Europe this year. Again, we think risks are on the upside now that the cost of living is increasing yet again. And if you look at the projections, last year inflation was about target. This year, we're expecting close to 7% inflation. Next year, we're expecting actually about 3% inflation yet again. So I think the risk is that inflation expectations adapt to these current high inflation levels. And again, services prices and wage demand surprise on the upside.
There's a big debate, Semin, in the central banking world about whether they should allow inflation to run a lot hotter this cycle than the 2% target that a lot of them have put out there for years. Do you think that this argument has credence, that basically it makes sense to allow an economy to run hot, especially because a lot of the inflationary inputs are due to commodities and things outside of central bank control?
I think we are actually in an inflection point, at an inflection point in terms of inflation expectations, because currently, despite the fact that the Fed has communicated with the market that they are looking to bring rates above neutral to restrictive level, and despite the fact that they will start with a quantitative tightening, we are still not seeing financial conditions tight. And despite a large sell-off in nominal rates, real rates are still at negative levels in US and deeply negative levels in Europe. So we still believe that the Fed might still need to convince the market and maybe still point to higher terminal rates and maybe possible sale of treasuries instead of passive runoff of their balance sheet, so that the market is convinced that the probability of inflation overshoots is lower long term, and long end inflation expectations fall and real rates may rise to a positive level. And then we could see a correction on risky asset valuations, because the alternative scenario is market participants pricing in a new regime of higher structural inflation for longer and testing central banks in a new way. Obviously, in the recent past, central banks have been more focused on the opposite risk of low inflation, and they were concentrated on how to provide further monetary policy accommodation at zero lower bound. But the discussion has shifted significantly now.
Semin Power, thank you so much, of the Bank of Ireland. There was some news headlines just breaking that VTB, the Russian-owned bank, is putting up its European unit for sale, and this comes as they feel the fallout of the sanctions. It's notable that the German regulators are backing this to try to control the fallout from a possible sale. But Kailey, it really raises a question to me of how they manage all of these companies, not just Russian companies, but also the likes of big oil majors, of the likes of beer companies. How do they manage to sell units when these assets are pretty much pariahs and there really will not be bidders?
Yeah, can you find a buyer, or do you basically just have to decide we're getting out of there and taking the hit on it because we can't? I think that is the question, Lisa.
And then when it comes to the financial industry, and this is why German regulators are coming in and taking a stance, what is the potential fallout? What is the potential risk on that front? And I know you've been watching European banks and kind of what the fallout could be, and how much this is really still baked into valuations versus unspoken for pain that could come down the pike.
Yeah, and another story to mention in that context is Renault. We were talking about this earlier. That stock under pressure today because they have a big Russian asset. How exactly they offload that, even though they've said they intend to get out of the country, is a big question. Coming up on the program, why half of Russia's 20 richest billionaires are not sanctioned. More from today's Big Take story next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, former U.S. Energy Secretary Ernest Moniz. This is Bloomberg.
We have now seen, finally, full proof of the fact that this regime is a threat to economic prosperity and peace in Europe, and it's in a long-term interest to make sure that Russia somehow, by itself transitions to a more democratic equilibrium, away from this authoritarian equilibrium in which it has found itself. So that needs to be the medium-term objective, and certain sanctions will have to remain, and in fact will have to be intensified for that to be achieved.
That was an advisor to the president of Ukraine speaking to Guy Johnson and I yesterday. Now let's talk more about sanctions, because half of Russia's 20 richest people have been sanctioned over the Ukraine war, but 4 of the 5 top billionaires remain free to operate without legal restrictions. A Bloomberg analysis shows that they are among a group of powerful Russian tycoons who have so far escaped penalties. And that is the subject of today's Big Take, co-authored by Bloomberg's Stephanie Baker, who is joining us now. So, Stephanie, why did you decide to pursue this investigation, and what did you find?
Well, as we know, besides weapons supplies to Ukraine, sanctions are the main tool that the West has to counter Russia's invasion of Ukraine. And a lot of the sanctions have been targeted at so-called Russian oligarchs, the billionaires that are so dominant in Russia's economy. And it's been a real dizzying stream of Russians that have been sanctioned in the US, the UK, the EU. Half of Russia's 20 richest men have been sanctioned, but half have not. And what we really wanted to do was try to analyze the list of who's blocked and who's not, and where, and try to make some sense of it. In some cases, it's a real head-scratching list and reveals a real patchwork of penalties across the world.
Yeah, Stephanie, is there any sense as to who is included at all? And is there any sense as to who is included by which jurisdiction? Because, of course, we have the US doing one thing, the UK another, Europe another. That all might be for very good reason. But is there any sort of sensible structure that comes across as you analyse this data?
Right. So there is overlap between Washington, Brussels, and London, but not as much as you might think when you look at the data. And there are only 3 billionaires in the top 20 who are sanctioned in all 3 jurisdictions, which is quite surprising, actually. And there are some billionaires who have not been sanctioned by the US. I think overarching, there's a concern about sanctioning billionaires whose companies play an outsized role in global markets, particularly metals, steel, energy, of course, and fertilizer, where Russian supplies are really key to global markets. And all of those commodities have experienced price rises even before the war began.
Yeah, so those who are making these sanctions, drawing up these sanctions, clearly mindful of any sort of blowback onto their own economies from the sanction activity that they engage in. Stephanie, thank you very much. Bloomberg's Stephanie Baker with today's Big Take story. NI Big Take on the Bloomberg terminal if you want to get more details on that. So that's the billionaires, if you like, that are facing sanctions and are not. But multiple rounds of sanctions targeting Russia are among the most complex ever enforced as European and US firms scramble to entangle themselves from or detangle themselves from Moscow. ComplyAdvantage is a fintech company that uses AI to reduce risk around financial crimes, and it's found itself in the spotlight. Joining us now is Charles Delingpole, the founder and CEO of ComplyAdvantage. Good to speak to you then, Charles. So we were talking there to Stephanie about how, some billionaires in Russia have been sanctioned, others have not. It's generally very difficult, I imagine, to keep across for every business and every part of every bank and legal business to keep across who exactly has been sanctioned. So how do you go about keeping track of it all?
Exactly. It's great to be here, Stephanie. So I think the challenge that banks, payment companies, fintechs have had is dealing with the huge numbers of politically exposed persons, of sanctioned entities, of subsidiaries, of people like Jeffrey Epstein who've been involved in sex trafficking. So the problem isn't just sanctions, it's much, much broader. And within banks, compliance teams have been struggling for many, many years with this particular challenge. It's simply that Russia and the past few weeks have been a real step change in terms of how that's grown.
Kailey.
Well, and on the subject of Russian sanctions, how do you navigate the differences between countries, sanctions that the US may have in place that Europe does not, and vice versa?
So the real challenge is the sheer scale of the problem in terms of if you're a fintech company or a bank, you might have 15 million, 20 million clients. And then every single day, you have to be able to triage which of those clients are problematic. So what we're doing is looking at each of the different different underlying regimes around the EU. So you have to look at Belgium, at Monaco, at France, each of which different regimes are very, very different, and then consolidate those profiles in single profiles, link those profiles to all different entities that those underlying different billionaires control, all the different subsidiaries and minorities, and be able to track efficiently all those different underlying counterparties. And that's a huge problem and a huge challenge.
Well, so Charles, once you're able to do that, track it all down, understand who's sanctioned and who is not, where does it usually end up for your clients in terms of exposure? How much exposure do they have to these sanctions entities on average?
So we've seen many banks and fintechs that have been fined by US Treasury, by the UK Treasury for violations of things like the 2014 Crimean sanctions. Things are very, very challenging before, but things have really taken a huge step change in terms of the complexity, in terms of the difficulty that they've faced. So it's very, very different for the big banks that are funneling billions of dollars versus the small fintechs and payment companies and gaming companies that have much smaller, different levels of exposure. But the underlying challenge is it's the entire economy. It isn't just the big banks. It's every single company in the entire world has to deal with counterparties along the defense supply chain, along the entire economy. And here it's a huge different level of exposure that they have.
Yeah, and how much clarity is there in the sanctions themselves, Charles? How easy are they to understand and to apply? I was reading some people talking about, how there might be strategic ambiguity deliberately put into the sanctions to try and give them a broader effect than maybe the sort of letter of the law would indicate.
So when the Bloomberg article came out about 2 weeks ago with the data that we published on the different benchmarkings of sanction levels amongst different underlying governments. What we saw was that some countries had much higher levels of sanctions than other countries. And the UK, for instance, claimed that the different subsidiaries counted in that number. So I think, particularly on that point, the number of subsidiaries that each different entity would have, there was great ambiguity, and it was very different to understand which governments were really in the vanguard of tackling the different oligarchs and countries that were really in the vanguard of this particular war. So I think there was a huge amount of ambiguity there.
OK, so some ambiguity in that. Thank you very much, Charles. Good to speak to you. Charles Delingpole, founder and CEO of ComplyAdvantage. Thanks for joining us on set here in London. Coming up on the programme, more on Russia and Ukraine with Wilson Centre President Emeritus Jane Harman. That conversation at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.